You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from the Moose on the Loose. Happy Thursday. Today, with the market going crazy a little bit these days and a lot of volatility, I think it's time to talk about how well can you protect your portfolio with different type of asset allocation, right? We've been used to a pretty generous bull market for like 15 years now and counting. A few bad years along the way, but overall we've been blessed, right? It's been one of like the best timing ever to invest, but maybe today you're starting to feel that it's a little bit more volatile and you would like to protect your portfolio. I got a question the other day from a DSR members, and it was like, what's the impact of diversification on one's portfolio? So first, when you're thinking about the equity side and you want to be diversified across multiple sectors, it is going to improve your diversification and lower a little bit your volatility. But keep in mind, if the market crashes by 30%, there's no place to hide. It's going to hurt. The point of diversifying with sectors is to not get hurt by one single market event. If you invest all your money into automakers and there are tariffs applied on those, well, chances are your portfolio is going to take a major beating as compared to have like a wide diversified portfolio investing in multiple industries, right? You get that. But now, what's the difference between a 100% stock portfolio versus one that has a 40% stock, 60% bonds, and another one, 20% stocks, 80% bonds? So really a full growth mode, a 100% equity portfolio, another one that is like, we could say balance, anything between 60-40, 50-50, 40-60 is about balance, but this one is like balance, more conservative, and then you have like the ultra conservative or income focused portfolio. What I did is I look at the iShare all-in-one ETF. You probably know XEQT, which is the common one for a lot of investors in the accumulation phase, because they just say, well, XEQT and chill, right? 100% stocks, well diversified across the world, 9,000 like companies inside it, kind of crazy. But BlackRock, under iShares, are also offering different other types of asset allocation with the same principle. So I've taken a look at XEQT, but also XCNS, which is 40 stocks, 60% bonds, and XINC at 20% stocks and 80% bonds. So we're going to call them equity portfolio, conservative, and income balance. So the income balance is like very the safe one. And what I did is I went back into 2020 to see how those three portfolios reacted to COVID. So especially in February and March, because already in April, we were going back into growth mode. How crazy was that? But still, so the perfect timing was like end of March. After end of March, if you like were waiting on the sideline, I mean, the stock price, like the equity market went up big time. So for that specific period of time, the equity portfolio XEQT went down by almost 30%. So that was like a huge drop. It started the year, January, February was positive, and then boom, all of a sudden it started to go down and go fast. So about 30% drop. Now, if you look at the conservative one, like 40% stocks, this one was not even at down 15%. So from the beginning of the year, not even down 15, like the other one was almost down 30. So a big difference by having 60% of your portfolio in bonds, right? And then the last one, the income portfolio with only 20% equity, was down, but roughly like 5-6% from the beginning of the year. So not so much. And then all of those ended the year in positive territories. What is really interesting here is from January 1st of 2020 till December 31st, the total return of those three portfolios are almost identical. So the safest one is at 9.20%, and the equity portfolio, it is like full growth mode, is at 11.85. So 2.5% difference between like 20% stocks or 100% stocks. That's kind of crazy. And then you're going to think, but Mike, I mean, what's the point then of investing in a fully full equity portfolio? Well, the difference is over a longer period of time. Unfortunately, this one, I mean, they're not super old ETFs. I wish I could have like 15, 20 years of data, but just for the fun of it, I just look at the past 5 years. So starting on January 1st of 2020, just investing right before COVID. So in 2020, we had the big drop due to COVID. And then in 22, we had a bear market as well. A small bear market, you're going to tell me, but still was another time where the market was dropping by 20%. And then I looked at the total return over those 5 years, including 2 moments where we had a lot of volatility and a lot of like down cycle. So the conservative portfolio has been up after 5 years, including the distributions, have been up by 15.6%. The 40-60 portfolio has been up by almost 29%. And XCQT, 100% stocks, up by 74%. So from 15.6 to 74%. That is the range of difference in terms of returns only after 5 years. Of course, now we're looking at a portfolio almost at an all-time high. It gives an advantage, an edge of like for portfolios that are more invested in stocks. But just wanted to show you the difference, even though, keep in mind, 5 years is it's not even midterm in my mind. It's like not like we're getting close to midterm investing here, but it's still pretty much short term. Depending on the 5 years you look at the market, you're going to have like completely different conclusions. What I wanted to show here, though, is the difference between a bad year where the heavily invested in bonds and fixed income will protect you from volatility and will not necessarily generate that much less of returns than the 100% in equity. But over the long run, the 100% equity will likely win. Sometimes a lot, sometimes not so much. In this case, of course, it was like a huge difference, but that is also related to the timing of and the number of years that you're looking at. So it's not always the same thing, but of course, if you want to maximize total return for the long run, this is the best way to do it. Speaking of maximizing your return, I focus on a 100% dividend growth portfolio, and I explain why and how you can do it too in the Dividend Income for Life guide. You can download it for free. If you're not on my newsletter already, just go to moosemarkets.com/income. You'll be able to enter your email there, download the guide for free. And in this guide, I explain the difference between dividend investing and dividend growth investing. I explain how picking stocks by yield is quite dangerous and could destroy your portfolio, while you can actually retire and generate that dividend income that you need for the rest of your life by selecting low yield, high dividend growth companies. So you can download it at moosemarkets.com/income. It's 100% free. And if you are a DSR members already, you have a complete guide already in the DSR fundamentals. So you don't need to sign up for the free stuff. It's even better on the other side of the membership paywall, of course. All right, Moose. So that's enough for today. Keep in mind, when you invest, the volatility is part of the game. So we have discussed that with TFI International at the beginning of the week. Sometimes it sucks, but if you keep your eye on the prize and you have a long-term mindset, the stocks are going to do a lot better than the GICs. Of course, it always depends how well you sleep at night with your investment strategy. So, right, Moose, that's enough for today. Tomorrow, we're going to talk about some pre-retirement investing strategies that you can put in place as you are getting ready to move into that transition that is really important to be retired. So stay tuned and stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose on the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.